40% of employees lost their retirement by holding just their employer's stock. Shocking, right? Today's focus is diversification, why it's crucial, and how its failures can tank your returns. Here's the hard truth: too many investors put all their eggs in one basket. Maybe it's company stock, or perhaps it's one popular sector. Why does this create such massive risk? Imagine relying on a single stock or industry. If things go south, your entire portfolio takes the hit. Example: many employees invest heavily in their employer's stock. It sounds logical, the company is familiar, and investing feels like doubling down on faith. But here's what few realize. If the company collapses, you're not only losing your salary, but your retirement nest egg too. Double blow, all thanks to concentration risk. Then there's local bias. People tend to invest in businesses close to home because it feels familiar. But a portfolio with local-only exposure misses out on global opportunities, and worse, amplifies regional risks. Think back to economic downturns. One poorly performing area tanks your portfolio if you aren't diversified. Diversification works like this. Instead of having all your investments in one stock or one sector, you spread them among different industries, regions, and even asset types. Stocks, bonds, real estate, indices. They lower your risk while increasing possibility for stable returns. Now, what about proper portfolio balance? Here's another trap: people sometimes own too many of the same kind of asset without realizing they're only relabeling risk in different forms. Buying 5 tech companies doesn't count as diversification when they react similarly to market conditions. The takeaway is simple: diversify across investments that don't move in tandem. You want some assets to rise when others fall. ETFs are excellent options for beginners to maintain diversification without actively managing individual stocks. And it doesn't stop there. Rebalance your portfolio annually. Over time, outperforming sectors dominate others, which reshapes your diversification. Adjust allocations to stay steady, so no single tunnel vision drives your risk profile. Diversification is a game changer, but many miss its significance. Don't let concentrated risks override your financial stability. Follow me for tomorrow's session, where we'll wrap up the big lessons from all 7 days. The key to winning? Sticking to a long-term buy and hold strategy. Let's crush those biases together. Hit subscribe now. Join the crowd, a free weekly newsletter to help you trade with the professionals.